Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a new week. We actually have a lot to cover this week, so this will definitely be a much longer video than you are used to. Let's get right into it. The first thing we're going to talk about is last week's CPI print. This is the inflation number and the inflation reading that everyone talks about in the market. It came in at 8.6%. Now, the previous month, the reading was only 8.3%. So the market was expecting that it was actually going to be leveled off or go down a little bit. But what we're seeing is an increase of that, which is an indication that the Fed monetary policy that was taken weeks and months prior has not had the intended result that they were wanting. And now that leaves us in a bit of a pickle. This week, the Fed is supposed to come out on Wednesday and have their rate release announcement and press conference. Now, up until this CPI number on Friday, the sentiment was that the Fed was going to increase their Fed funds rate by 0.50%. Then over the weekend, some people started to chatter online and economists saying maybe they need to do 0.75%. And as recent as this recording, there's now even some people saying the Fed could do a whole 1.0% rate hike on Wednesday, now as a result simply of Friday's poor inflation report indicating that their previous moves have not had the impact that they need. So this is certainly not the position that they want to be in. This is certainly not the position we want to be in as an economy. And it's not the position we want to be in from a mortgage position as far as rates are concerned either. What this really means in the short term is that rates are going to have some upward pressure, and they already went up this morning on Monday. They are possibly going to hold in this range by Tuesday and await Wednesday's decision. Wednesday's decision will be part of what influences rates, and then the press conference and the comments Jerome Powell makes on Wednesday will be the other part of what happens to rates. So the combination of the decision that's made and the commentary about the health of the market and the moves they're making and why they're making, we're hoping to see some sort of indication that'll tell us whether we're going to come back down for a little bit of relief in rates sometime this week or maybe at the end of the month, or if it's just going to be a new level that we're going to have to contend with coming into the end of June and into the beginning of July. Now remember, there's also a July Fed meeting that is scheduled to happen as well, and then there's a break until September when they will come back again and announce another rate decision and have a press release, a press conference. So really, this week and the meeting in July are really paramount to determining where we're going as far as rates are concerned, how that's going to impact the market, and then whatever those decisions are, they're going to take time to make their way into the market and then through the market so we can see what the direct impact of those things are. So we're going to have to kind of, I don't want to say wait with bated breath, but we honestly have to kind of see where this is going to go, because you already see it's starting to make its way into the equity markets, where you see the Dow and the S&P and the NASDAQ all selling off super hard these last couple of weeks as a result of the economic information that's starting to come out. You may remember that a couple weeks ago I made a video about is there a case to be made that high inflation could result in lower rates down the road? Well, the answer is still yes. It's just not going to be like right now. The problem I think we're facing is that as the inflation number continues to cook hot, and until that starts to like downturn and show some easing and some signs of relief, there's not really an indication that the Fed can take their foot off the pedal. They're going to have to be super aggressive. Now, eventually, that's going to cause so much slowdown in certain areas of the economy that they're going to have to ease pressure again. And then easing pressure is what historically has led to rates going down, getting money flowing again, letting lending happen at a normal, healthy rate. And so we know we saw this, I'll say, unhealthy rate of lending when it was at all-time highs the last couple of years and rates were at all-time lows. And then we're seeing the beginning of maybe some unhealthy lending because it's too much too late in the game, and them cramping down is starting to put pressure as far as rates are concerned and stalling out some efforts to keep the market going. We just talked about a bunch of nerdy things. Let's talk about what that means here locally in San Diego. First things first. If you are looking to buy a house, it is really important right now that you rerun your pre-approval that you might have had 30 days ago, 60 days, or 90 days ago. Now, the price has not only changed since then, but in forecasting that it might even go up by another 0.25%, maybe 0.5%, it's time to take a look at that and understand what does that mean on the upside to you as a buyer. We also are assuming that if you're buying a house in this market, that you're buying this house and you're going to be here for at least 5 or 10 years, and maybe even longer, 15 and 20 years, especially those of you watching this who have young kids. Maybe they're in preschool, they're in kindergarten, and you're looking for the neighborhood you're going to be in for the next 15 years to 20 years anyways, because if you're talking about being here long term, then you're looking through elementary, middle school, and high school. So take that into perspective. Getting the house you want now is one thing. Financially getting yourself in a better position later when there's a correction in the market rates-wise is another. So keep that in mind as you're getting your pre-approval rerun. And if it's been 30 or 60 days since you've had that done, go ahead and talk to your loan officer today or this week and let them know that you want to get your pre-approval updated and refreshed. The next thing I want to talk about is cash out refinances. Yes, I know this sounds a little crazy right now just because of the tone of this video, but also what's happening in the market. But there is still a case to be made for people who have all-time high house price matched with all-time high equity. Now, that equity is trapped unless you access it. You're only accessing it by either getting a line of credit, if you can get one, or by doing cash out. Now, there are two cases recently that we've been seeing kind of recurring here at the office. The first is the homeowner who has a lot of equity trapped in their house and they have a side business already, or they're starting a side business and they're using some of that equity to be the funding source for that side business. So if you currently qualify in order to do that and take $75,000, $100,000, $150,000 out of your house, this might be a good time to do that. Yes, I know that the rate today is different than 3 months ago. However, your equity is still holding, and this would be the window to take advantage of that. The second thing is people who are doing debt consolidation at, I'd say, a mildly high level. So if you're somewhere around $40,000, $50,000 or more in personal debt, meaning credit card balances, car loan balances, personal lines of credit, maybe even student loan debt. This might be a time where if your house has enough value and equity in it for you to reconsider that. Because the combined total of your current monthly mortgage payment and your car payments, credit card payments, student loan payments, the totality of that might still be more than if you took cash out to pay those things off and had a new higher mortgage payment. Now, I understand that mortgage payment, apples to apples, may not actually be in your favor at first glance. However, when you consider all of the monthly payments you're making against all the other lines of open credit you have, it might actually work out. In one case recently, we had someone do about a $60,000 debt consolidation and left some money in their bank account. So while they did that consolidation, it actually saved them over $500 a month out of pocket because they paid off one of their vehicles, they paid off all their high interest rate consumer credit cards and a personal line of credit. So it's not to say that you should refinance because rates are great. No, it's does the situation meet the needs that you have right now in the market? So take a look at that and assess whether right now you need to do that for the next 24 or 36 or 48 months. Even if it's a temporary solution that gets you through the next 2 or 3 years, that is something you should definitely talk to your loan officer about and see if the math works in your favor. Now, to kind of tie all this up, I want to just let you know that we've been through something similar like this before. You know, this company's been around since 2005, and we went through the 2008, 2009, 10, all that collapse, all that mortgage fallout, and you know, we've seen a lot of things, and I wanted to just personally address those of you watching this who may feel like you don't want to come forward because you don't want to ask for help. We are here to help you. It is really important that you raise your hand, you raise your voice, you email, you text us, you make a comment, send a DM, let us know that you need help. If you don't tell us you need help, we don't know, but we can help a lot of you who might be in a situation now that you just need to cure for the next 2 or 3 years, and then you can come revisit this and figure out, okay, what does it look like now after that 2 or 3 year period? But right now is the time where, you know, even if you're feeling a little bit embarrassed about the situation or maybe ashamed or prideful, I just ask that you take a mathematical consideration of the circumstances and then make a choice to step forward and let us know how we can help. There are going to be situations where there's nothing we can do to help you. But for those of you who need help and we can help, let's at least try to put a solution on the table that will help ease some of your financial pressures you're having right now. That's it. As always, thank you guys so much for watching. Please share this video with someone you know, like, and trust. And if you do need help, please send us a DM. Call or text your loan officer. You can email them as well. We earnestly want to help people, especially in the landscape that's changing so much right now. We know what we're doing in this type of market. We've been through this type of market before, and we also lived through it. So there's a little bit of staying power that I hope you see that there's some credibility to stepping forward, asking for help, and maybe there's a solution in the market for you right now. Thanks for watching. We'll see you again next week.